Good afternoon, everyone. My name is Venki Venkateshwaran, and I'm delighted to welcome you all to the 25th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as our students and alumni. We're pleased to have in the audience today students and faculty from all over NYU, as well as many of our alums. Thank you very much for joining us. Today's session will last about 90 minutes. It'll begin with short presentations of about 10 minutes each by each of the panelists about their market and economic outlook, followed by Q&A. We'll finish by 6:30 p.m. To ask questions, please enter them through the Q&A feature in Zoom. I will moderate the session and try to limit repetition by grouping similar questions together and presenting them to the panelists. Given the time constraints, we may not be able to get to all your questions, so my apologies to all of you in advance. Let me now briefly turn to introducing our distinguished panelists. Again, they have accomplishments. They're very accomplished resumes. I'm going to leave out more than I will be able to say, so I encourage you to look up their resumes on our website. But I'm going to start with Solita Marcelli, who is Chief Investment Officer Americas for UBS Global Wealth Management, where she leads a 300-plus member team providing tailored advice on asset allocation, equity and fixed income strategy, sustainable investments, and more. Prior to UBS, Solita was the global head of fixed income currencies and commodities for wealth management at JP Morgan. She's widely recognized as a thought leader in the industry and is featured frequently in the financial media. She was recently recognized as one of the 100 most influential women in U.S. finance by Barron's. Outside of UBS, she serves on a number of boards and advisory councils and has received numerous leadership awards. Throughout her career, Solita has long been a strong and passionate advocate for diversity, equity, and inclusion, having co-founded a private banking women's network and spearheaded a sponsorship program designed to elevate diverse talent. Perhaps even more impressively, she holds an MBA from the Stern School of Business and a BA in Economics and History from Brandeis University. We're delighted to welcome our alumna, Solita Marcelli, to the forum.
Thank you.
Next up, Dr. Aparna Mathur is a senior research manager in economics at Amazon, where she tracks and conducts research to help identify labor and employment-related challenges with a view to informing best policy. She's also a senior fellow at Harvard Kennedy School's Mosawa Rahmani Center and a visiting fellow at the Foundation for Research on Equal Opportunity. Prior to Amazon, she spent time at the Council of Economic Advisors as well as at the American Enterprise Institute. At AEI, she directed the AEI Brookings Project on paid family and medical leave, building bipartisan momentum on paid leave, for which she was recognized in the Political 50 list in 2017. Her research on inequality, tax policy, and labor markets has been published and cited widely, both in academic journals and in the news media, where she's frequently featured and it provides expert commentary. She received a doctorate in economics from the University of Maryland, College Park, and currently serves on that university's Economics Leadership Council. She's also on the boards of the National Academy of Social Insurance, Simply Green, and the National Economists Club. Aparna, welcome to Stern.
Thank you.
Finally, last but by no means the least, Matthew Lizzetti is Chief U.S. Economist and Head of U.S. Economics Research at Deutsche Bank here in New York. Earlier in his career, Matt has also worked at the U.S. Department of the Treasury in the Office of Financial Research, as well as in the Macroeconomics Research Department of the Federal Reserve Bank of Philadelphia. Back in 2017, Matt was named to the Business Insider's Rising Stars on Wall Street Under 35. His research has appeared in several books on economic policy and in academic journals. He holds a PhD in economics from the University of California, Los Angeles. I had the good fortune of overlapping with him while at UCLA, so I'm particularly excited to welcome him back to Stern. Matt, welcome. With that, I'm going to hand over to the panelists. So we're going to go Solita, Aparna, and then Matt.
Thank you very much. Thank you for having me. It's really great to be back to NYU Stern, where you said I would like to say not too long ago, but it's been a quite long time since I was sitting in those seats, and it's a pleasure to also share this forum with Aparna and Matthew. Looking forward to hear their thoughts as well. So I thought I'll start with maybe some thoughts on the economy first, and then get into how we're thinking about the financial markets. And before maybe I dive into the current macro picture, what I wanted to do is really to zoom out and maybe appreciate the resilience of the US economy in the recent years, right? Like, think about the fact that if it wasn't for COVID, we could very well be in the 15th year of the economic expansion. Now, that's hypothetical, of course, but the economy did appear to be reaccelerating in 2020 before the pandemic hit. And I point this out not to reminiscence only, but because it really speaks into the structural transformation of the economy over the last 50 years. So this is simply not your grandfather's or grandmother's economy. And that has, I think, important implications for the future. As you can see on my first slide here, we are now, to surprise to nobody, right, a knowledge-based services economy. Manufacturing's share of private sector output is half of what it was in 1970. The energy required to produce $1 of GDP is about 35% of what it was back then. So it's less capital intensive, less impacted by energy prices and inventory cycles, and less interest rate sensitive. I think this helps explain why the US economy has also become less recession prone, why expansions have become longer, and why in recent years we have been able to come back into balance after the inflation spike and policy shock without a recession. So, what does this all mean going forward? Well, today, recession concerns obviously have started to creep back up into the picture after we had a string of weaker data, especially a rising unemployment rate. And we do believe the recession risk is, in fact, increased on the margin. Right? We see about a 25% probability of a hard landing. That is up from about 20% a month or two ago. But still, our base case here at UBS CIO is that economic resiliency will ultimately shine through again. I think growth will continue to cool, not crack. In terms of our forecast, it is just below US GDP, below trend for US GDP growth over the next 6 to 12 months, trend being around 2%. So I would say there are a few reasons why we believe we are headed towards a soft landing at this point. So the labor market is definitely softer, but it's still strong from an absolute perspective. Unemployment has picked up, but still very low. Wage growth has slowed, but stabilized. And businesses are still looking to hire, while layoffs are still relatively low as well. So from our perspective, all of this should keep consumer spending from falling off a cliff, even if it's likely to moderate from its current pace, especially given that spending at this point is outpacing income, which from my perspective is not sustainable. And especially in light of the fact that much of the excess pandemic savings are used up. The rise in unemployment is clearly concerning. And I would say from our perspective, it will be the number one risk to monitor. But I think, some of this can be attributed to increased supply from immigration and also people entering the workforce. I said not entering, but re-entering the workforce after the pandemic, as opposed to a faltering demand. And if you're looking for an evidence of this, I would point to the fact that, initial jobless claims are still relatively low. So I would say that's my sort of first point. Secondly, some of those typical recessionary signals are still not flashing red. We don't see any imbalances in the economy that are too concerning. When you look at investments as a percentage of GDP, it's not excessive. So there shouldn't be an overinvestment hangover at this point. And overall, when we look at household balance sheets, they're healthy. there are, of course, ups and downs in the weekly and monthly data. In the grand scheme of things, still the US consumer is in very good shape. Median household, we look at the median household wealth, it's up about roughly 40% since pre-pandemic. Obviously, a lot of people's home prices went up, right? And while higher rates certainly do pose challenges, just from an overall perspective, the consumer here in the US has been actually fairly shielded thanks to our best friend being the 30-year fixed rate mortgage, which, by the way, is not the standard in most of the world. So where we're seeing more pressure is on the lower end consumer, but the medium to higher end seems to be holding up still quite well. So that's my third point. And the third point, I would say, of course, we can't ignore that there are risks. And, the saying goes, something could break given the restrictive monetary policy in place. But I think the best problems to have are the ones that also have known solutions. And that is the case here. If you look at this slide 4, with disinflation underway and set to continue, at least from our perspective, the Fed has ample room to cut rates more swiftly if needed. I think which will be, of course, necessary to extend the expansion from here. So the big debate in the market, how many cuts, when it's starting is not so much of a debate, but our view is that we would see about 100 basis points roughly rate cuts this year, starting this month, and that would be followed by another 100 basis cuts next year as well. So in a nutshell, I would say, and this is our macro view, if I just recap what I mentioned up until now, basically slower but positive growth on the road to a soft landing, not recession, Fed cuts upcoming, and disinflation ongoing. All right, so if we sort of get to markets, what does this all mean for financial markets? Okay, so we just lived through the crazy August. Market is more stabilized, but market volatility clearly has returned. And things could remain choppy, of course, whether it's due to softer growth data, headlines around potential import and trade restrictions. The season for that is coming in October, among other things. But looking ahead, I still think the outlook for U.S. equities is pretty constructive for 3 main reasons. Okay, number 1, the soft landing environment, which I just talked quite a bit about. 2, the artificial intelligence tailwind. And 3, healthy profit growth. So let's maybe unpeel each one of them a little bit. Okay. So first of all, on the economic backdrop, as I said, we believe it's supportive for stocks, and you can see this on this slide 5, right? If you look back at history, the S&P 500 averages about 17% return in the 12 months after the Fed's first rate cut, especially in the instances when the economy also avoided recession. And as I mentioned, that is basically our expectation. Secondly, we expect very strong spending on artificial intelligence infrastructure to continue by companies in the months ahead, right? I think this will be led by mega cap tech companies, as you can see here on slide 6. And I know there are some concerns that these companies could actually be overinvesting. And of course, investors, everybody wants to see the ROI, return on investments. But I think some of those concerns might be a bit premature. And, let's remember that these hyperscalers are dominant players in their industries. They have pristine balance sheets. They generate huge free cash flows. So at this point, if you're kind of trying to balance sort of the trade-off between risk and reward, right? I think the risk of overspending on AI by billions is dwarfed by the risk of missing out on what could be a trillion plus dollar market in the next few years. And then finally, maybe just to touch on earnings on slide 7 here. Okay, so obviously we're wrapping up the second quarter earnings season. It wasn't as strong as maybe the last few quarters, but still, right, we're looking at a 11% earnings growth in that quarter, year over year, which is very healthy. And earnings growth also continues to broaden out beyond the Mag 7 type names. So for the full year, we still expect about an 11% earnings growth. Again, a healthy earnings growth. So I think it's a good environment for stocks, and especially tech stocks, right? This is one of our favorite sectors because you can play a bit of offense and defense with the technology sector. Offense in terms of benefiting from the surge in AI spending, since it is tech companies right now who are on the receiving end of that upfront investment, right? Especially those in what we call that sort of enabling layer of the artificial intelligence value chain, like semiconductors, data centers, and so on. But then, you're playing also defense as well because the economy is slowing down. And in that type of an environment, high quality growth companies, many of which actually live in the tech sector, are usually best positioned to weather the storm. Try to kind of paint a balanced, sort of a rosy balanced picture, maybe a little bit. But that doesn't mean, of course, there aren't risks. So let's talk about risks a little bit before we close it out. And probably I'm not going to get to all of them in the interest of time. Maybe we'll get to them in the Q&A. But I would like to touch on one, which is the U.S. election, because how can I not? We're a couple hours away from the debate. Look, it's a close race, right? We believe there are two overwhelmingly most likely outcomes. One would be a Trump victory with a red sweep, so it gets both the House and the Senate, or a Harris victory with a divided government, maybe doesn't get the Senate, but gets the House. So in the Harris divided government scenario, the main market risk, which is higher taxes, I think would mostly be neutralized. So I think this is more of a sort of a status quo outcome. But the Trump scenario is different, right? Now, maybe to level set, we actually think a red wave would probably be favorable overall for the equity markets because it also comes with potentially looser regulation, lower taxes, etc. But there's one big risk, and that is tariffs. So what we've done is we've categorized the level of tariffs we could see into 4 potential outcomes, which is the slide that you're looking at right now, slide 8. The first kind, I would say, is the gesture politics, right? Which are basically periodic new taxes imposed on specific products to make a political point. I think these would be the least disruptive. And then you have the selective tariffs, then sort of the next step up, which would be a broader application of trade taxes across multiple sectors. So it's not just a few products. And then next one is that you have the universal tariffs, which then starts to get very disruptive. And then finally, what we call extreme tariffs, which would be like the proposal of replacing income tax with a suitable tariff rate. We see selective tariffs as the most likely outcome under a Trump administration. Now, this would likely cause volatility, I think similar to the China tariffs in Trump's first term, but I think it would still be manageable. From our perspective, though, a more aggressive universal tariff poses a much greater downside risk to the US economy and the markets. Based on our analysis, this could bring up to 1 to 1.5% cumulative, not per year, but cumulative 3-year hit to US GDP. It's not our base case, but it's certainly another risk that we're monitoring. So maybe I'll just leave it at that, and then we can come back to it during Q&A.
Wonderful. Thank you so much, Solita. Aparna, take it away. Whenever you're ready, share your slide. Let me stop sharing mine, where you could go ahead, and then, go ahead.
Okay, great. Thank you so much, Venki, for hosting this, and thank you to the NYU Forum. for allowing me an opportunity to speak about the U.S. economic outlook. Just a disclaimer, I am an economist at Amazon, but I'm not representing the Amazon point of view. These views are personal. I am also, an economist at heart and a researcher, and closely follow, especially the labor market in the U.S. And so, a lot of my thoughts and opinions here will reflect that. I think I'm completely aligned with what Sulita was talking about, the U.S. labor market. So the roadmap for today's talk is I'm going to take a deeper look at the U.S. labor market, where we are starting to see a general slowdown in the economy, but without, I would say, broad-based job destruction. We will also look at GDP numbers, economic growth in 2025 and beyond. Talk about inflation, obviously, which is top of mind for everyone, and what is the Fed going to do on interest rates, and finally, also how is the American consumer behaving, and how do they view the inflation, the past year or so, and where they think the markets are headed. The U.S. labor market, so this is something I've been tracking for a while, even before Amazon, and just sort of tracking the monthly jobs numbers, because I do think that they provide a really strong signal of where the economy is headed. And as you can, during the pandemic, obviously there was a high level of job destruction. I was a senior economist at the White House CEA, and we were tracking month on month, the massive increase in the unemployment rate to 14.8%, the COVID peak of 14.8% in April 2020. But then also monitoring the recovery that was pretty dramatic right after that. So the unemployment rate today is at about 4.2%. Again, if you look at the COVID peak of 14.8%, this is obviously more than a 10 percentage point reduction in the unemployment rate. But we were kind of getting, used to having very low unemployment rates. I think we were expecting that unemployment would, continue to dip below 4%. We were at, I think, at 3.5% just before the pandemic happened. And so the recent sort of uptick in the unemployment rate, which is marginal, I think we've gone from something like 3.7 to, 4.2, is starting to worry and cause a little bit of concern, amongst economy watchers, I would say. So what I think is that, the U.S. labor market is steady and solid, but also slowing down. And this also shows up in the downward revision that the Bureau of Labor Statistics recently did to the employment numbers. So in March of every year, they sort of go back and say, did we overestimate the employment or the hiring that happened in the previous year? And the recent revision showed that, the economy probably added, 818,000 jobs, fewer jobs than had initially been reported. So I think that also is something that has, stuck in people's minds that, we thought we were creating jobs at a pretty solid rate, but actually, it's almost like, a million fewer jobs that we had created, and which is also concerning. And then the chart here shows you the number of unemployed people per job opening. And what we have started to see is, as the unemployment rate is ticking up a little, the number of job openings has started to go down. And so again, why are employers creating fewer jobs? What is, how many people per job can, do we have? What is the ratio? What does that look like? As you can see, obviously during the pandemic in 2020, we had a very high number of people per job opening, and that number has significantly come down. So, yes, it's weaker, but again, like Sulita was saying, I think there are strengths in the data, even though, the trends are starting to look a little weak. I think when I look more long term, what are the structural pieces that are starting to, again, worry sort of people who are tracking the economy? The one thing where we are looking is labor force participation. So the labor force participation rate had dropped at the start of the pandemic to a historic low of 60%. Before the pandemic, we were at about 63. So we're kind of back. The labor force participation rate today is at about 62.7%. But we're all aware that, there's a big generation, the baby boomer generation, that's starting to move out of the labor market. They're starting to retire. And so if you look at the US population age mix in these charts, right, more and more people are now in that retirement phase, which means that, labor force participation is likely, there's a structural change in labor force participation that's likely to come. And, what does that mean for the economy? Now, labor force participation matters, obviously, because where do you get the workers to produce the goods you need? And, what does that tell you as a sign, for the economy? As Salita also mentioned, some of the pressure that we're starting to see on labor force participation is going down because of the influx of foreign-born workers. So during the pandemic, which is this blue line, you see the blue line see a big dip in 2020 where immigrants, the coming in of immigrants and relieving pressure on labor force participation, wasn't happening as much. But in recent times, we saw that increase in participation go up. And again, recently we started to see a dip. So yes, on the one hand, the baby boomer generation is retiring. On the other hand, we do see this influx of foreign workers that are likely to, fill that gap. But, so much depends on is that sustainable? How does that change as economic conditions in the US change? And a final, note on the labor market is, again, wage growth, right? So during the pandemic and post-pandemic, there was an interesting statistic that hourly workers were actually, moving and switching jobs at a high rate, and their, wage growth was at a much higher level at 6 to 7%. So average hourly nominal wages were growing at 6.2% in 2022, and now they're averaging about 5%. And the Atlanta Fed wage growth tracker also shows similar declines across different demographics. You see workers with college degrees and, women and men. Like for all of them, we're starting to see a little bit of a decline in wage growth, which is a sign of a slowdown again, but also maybe eases some pressure on the Fed. So what's happening to GDP growth? So CBO estimates that 2023 growth was about 3.1%, but is projecting only about a 2% growth rate going forward. So CBO is less optimistic for the next 10 years. CBO is the Congressional Budget Office that routinely puts out these forecasts. Economic growth is projected to average 1.8% a year from 2026 to 2034, when it had averaged about 2.1%. And a lot of the drivers of these lower forecasts are slowed consumer spending and rising imports. So, there's a sense that, when you look at outside the labor market at GDP numbers, there's again a slowdown coming. And then, what's happening to inflation? So again, if you go back a couple of years or even to last year, the biggest concern on everybody's mind was, oh my God, inflation is at a really high level. I know we were tracking at 8%, an 8% inflation rate. And now we're kind of back to slightly above 2%. We're not exactly at what the Fed targets, which is the 2% number. So, again, there's some interest in, well, how is the Fed going to read, the inflation data? I believe it's supposed to come out tomorrow. And what does that mean for their decision to cut interest rates going forward? Some of the biggest drivers of inflation, during and after the pandemic were food and energy prices, shelter, and medical services and so on. I think those pressures are starting to go down. So we do think we're on a good trajectory when it comes to inflation, but we're not, at the Fed target. And so I think for some of these reasons, like to me, it seems like a little bit of a mixed picture, right? Like we're seeing some solid indicators. The labor market is slowing down, but not really, dipping. And hiring is still pretty solid. And so, what does that mean for the Fed interest rate? A cut. I think the likelihood the market pricing that we're tracking shows like a 25 bips rates cut in September, a lower probability of 50 bips. I was interested to see, Salita's estimate that, we might see 100 bips, cut in interest rates. And finally, if you look at consumer expectations of future inflation, those have declined. If you look at the 1 year ahead forecast, it used to be really high in 2023 and has been steadily trending down. And finally, the 3 year and 5 year expectations are lower as well. Inflation is not as big of a deal now in consumer, mindsets when it comes to spending, and that's been a gradual decline as well. And finally, if you look at retail sales, retail sales, the early growth has continued to decline. I will point out, at least for Amazon consumers during Prime Day 2024, we did see an increase in retail sales over the 2023 number, and a similar increase between 2022 and 2023. So, for me, it's a somewhat mixed picture. There's been a slight, increase in the unemployment rate gradually. Inflation expectations and inflation itself has cooled down. Interest rate cuts seem likely, but it's not clear, how much. And finally, when you look at the economy and, GDP growth, there's a general sense of a slowdown. But, it's not clear, at least to me, how the Fed is reading all of these signals and what they're likely to respond to. Thank you.
Thank you so much, Matt. Whenever you're ready, you can turn your camera on and then go. Wonderful. Just a quick reminder to everyone: please type in your questions, and then at the end of Matt's presentation, I'll start curating them and presenting it to the panelists.
Thanks very much, Venki. It's a pleasure to be here, both with both of the panelists. Thank you to NYU Stern, Venki. And Venki was also modest. He was not only kind of a classmate where we overlapped, but he was also one of my TAs and teachers at UCLA. So it's great to kind of be back with him and be able to just discuss these things. I don't have slides, but what I plan to do is probably discuss a few areas of our outlook, emphasize the areas where they might differ a little bit from what you just heard in the two other areas. But then also focus a little bit more on the near term, think about the Fed decision-making process, exactly how we expect rate cuts to play out, how we're thinking about monetary policy over the longer run in terms of our star, and then maybe focus a little bit on kind of longer term aspects. So first topic, kind of soft landing versus recession. I would share kind of the optimism around a soft landing outcome with the rest of the panelists. For a while, we had been in a hard landing recession view of the world. But I would highlight a few things. One, kind of the imbalances in the economy that you typically have that precede recessions are not there. As Salita had mentioned, you don't see any imbalances in the typical cyclical sectors. If anything, the housing sector has been undersupplied, not demand that has been quite stretched. Two, when you look at debt service ratios for households, but also for firms, they are not particularly elevated. Three, if you look at things like financial conditions are actually quite easy. And you look at bank lending conditions, although they had tightened substantially last year, they have actually eased more materially this year. And so the typical preconditions that you would look for a recession, in our view, are not there. And so while there are, rightfully some concerns about downside risk to the labor market, we still have a view of a soft landing for the U.S. economy. We have close to 2.1% growth this year, a little bit stronger growth as we look out to next year. But we see a steady growth environment as we look ahead. I do think it's notable that even as there's been so many concerns about recession risks in the U.S. economy, when you look at consensus expectations for growth this year, they've actually risen to the highs in terms of expectations. The Atlanta Fed is expecting 2.5% growth in Q3. That's after 3% growth in Q2. And we're coming off of very strong consumer spending data. So while there are concerns, our baseline view is a soft landing for the U.S. economy. Focusing now on the labor market, that is the area where there is kind of the prominence of concerns that are there. And a lot of that is being driven by the loosening of the labor market that we've seen. The well-known SOM rule has been breached, a 50 basis point rise in the unemployment rate. If you look at the 3-month moving average relative to the min over the past 12 months, over the past 2 months, we've seen that been breached. But for the most part, that's catching up to a lot of other labor market indicators that we focus on. The quits rate, which is a very reliable leading indicator for the labor market, has been back at 2018 levels for a period of time. The hiring rate has been at 2014 levels for a period of time as well. And just finally, when you look at job openings relative to the unemployed, that has just recently fallen below 2019 levels. So we view the rise in the unemployment rate as mostly catching up to a lot of other indicators that we've seen in the labor market already. However, importantly, the rise in the labor market has really not been about layoffs. When you look across the variety of evidence that we have on layoffs, whether it's the JOLTS data, jobless claims, as were already mentioned, challenger layoffs, the Warren indicators that we have at the state level, all of those indicators remain at historically low levels. And so when you decompose the stock of unemployed individuals today, it has been driven much more by labor supply, re-entrants, new entrants into the labor market, rather than a pickup in layoffs, whether permanent or temporary. Other ways to see that and to be optimistic about the labor market, when you look at prime age labor force participation, those households that are 25 to 54 years old, it's near record high levels. It is record high levels for women. And if you look at the prime age employment to population ratio, the share of people in that 25 to 54 age group that are employed, again, it's near record high levels. Both of those would be consistent with lower unemployment rates than what we currently have. That just highlights, I think, the role that is being played by labor supply rather than layoffs at the moment. That said, this picture does present risks. It does suggest that there is some fragility in the current resilient labor market that we have. And that fragility would turn into much worse outcomes if we were to see layoffs pick up. So that's something that we are certainly focused on and highlighting. At the same time, if you look at the layoff data, it's very binary. It's low until it's not, and then it spikes higher. And that's typically what happens during a recession. And so you need to kind of consider the overall macro picture when you think about layoffs. They are not simply this exogenous thing that move higher for no reason. And so the growth backdrop that I mentioned, financial conditions being easy, mortgage rates coming down, supporting the housing market, all of that, I think, should continue to feed through to a low layoff picture and some stability in the hiring rate as we look ahead. So the labor market, I would kind of agree, has cooled materially across all the variety of indicators that we would look at. A lot of that is being driven by labor supply and some softening in demand. But so far, at least, you've seen very little rise in layoffs, which is the typical trigger of recessions. Third topic on inflation is kind of interesting. Basically, the past 3 years, we've been so entirely focused on inflation. The Fed has also been entirely focused on upside inflation risks. But really, over the past several months in my conversations with clients, and as you saw kind of from the first two presentations, there's been a lot less focus on the inflation front. I would share optimism that inflation is on track to be much closer to 2% next year. And I think you could come to that conclusion both from a macro top-down perspective and from a micro bottom-up perspective. From the macro perspective, your typical Phillips curve models look at measures of labor market slack. And as I just mentioned, there's really no inflationary impulse coming from the labor market at the moment. At the same time, as Aparna had shown, across a variety of inflation expectations measures, their inflation expectations have remained remarkably well anchored, in part certainly driven by the aggressive move and tightening cycle of the Fed. And so that you're kind of left from a macro perspective with thinking about supply side stories, supply shocks, supply chain disruptions as probably being the most likely cause for higher inflation, at least for a period of time. But at the same time, when you look at supply chain disruptions indexes from the New York Fed or suppliers' deliveries from the ISM manufacturing index, there's really no evidence of that at the moment. So we don't see a strong macro story for why inflation does not continue to trend lower. From a macro, from a more micro perspective as well, I think it's pretty similar. Over the next few months, you could very well see used car prices pick up, given what we've seen from wholesale prices. But overall, consumers are showing greater sensitivity to price increases. That's leading to kind of a return of core goods deflation. We've seen core services ex shelter also moderate pretty substantially in recent months. Airfares, lodging away, healthcare inflation as well. And that really has left shelter inflation as the last main source of sticky price inflation. Now, if this was before the pandemic where we didn't have private sector estimates of shelter inflation, I think the current environment would be more worrying and would have left the Fed more hawkish. But the fact is we have a lot of private sector estimates of shelter and rental inflation. All of those have moderated substantially. And the BLS and Cleveland Fed have their own micro data that they show substantial moderation is to come as well. So we are optimistic and constructive that the shelter inflation component will eventually moderate as well. Our forecasts for core PC inflation, for the end of this year are about 2.6 to 2.7. and then for the end of next year are 2.2%. So you have a backdrop for the Fed, which is, in our mind, pretty resilient growth, soft landing remaining the most likely outcome, a labor market that has come into better balance that has some downside risks, and inflation that has moderated and should continue to do so. I think that's exactly the reason why the Fed has sent a very strong signal that they're going to be cutting rates at their meeting next week. The debate about 25 to 50, was a very strong and interesting one. And if you followed the market moves on Friday, the jobs report and then Fed communications really whipsawed markets back and forth. But I think when you take the data that we had on Friday from the jobs report, it did show some rebound in employment growth. The unemployment rate did tick down to 4.2%. The average work week picked back up. Average hourly earnings were stronger. And income growth implied by the jobs report is actually pretty strong at 5% year over year. There was meaningful downward revisions the prior 2 months, which from my perspective was, made it less clear cut for the Fed. I think if you had that jobs report without the downward revisions, it was clearly that they'd be leaning towards 25 basis points. And so we were all kind of looking at the Fed for communications on Friday, both from John Williams and Governor Chris Waller. Both of those officials did not really express urgency around cutting by 50 basis points at the September meeting. Governor Waller in particular, indicated that it would take a more significant deterioration to move the Fed towards more aggressive cuts. But at the same time, Chair Powell has drawn a red line under weaker labor market outcomes. And Governor Waller did indicate that he's willing to accelerate or front load some of these rate cuts. And so while we expect that the Fed cuts rates 25 basis points next week, it is not a done deal. And certainly over the next few months, if you see a weaker labor market outcome, then we anticipate the Fed could ratchet up to 50 basis point rate cuts. Where does the Fed end up in terms of their cutting cycle? That gets into thinking about neutral or R star. We've had a view that neutral and R star is higher than what the Fed anticipates. The Fed has raised their view of neutral from about 2.5% to 2.8% in nominal terms over the past 6 months or so. We think it's probably more closely in a band of 3.25% to 3.75%. That is in part based on a variety of the estimates that we track. And so we expect that over time, the Fed will get the Fed funds rate back down into that 3.25% to 3.75% range, most likely by the end of next year. But again, they've signaled that they're very willing and able to respond to weaker labor market outcomes and move more aggressively as needed. Maybe just two final points. One, from a longer term growth perspective, we'd be more constructive, I think, than what was outlined from the CBO. That being primarily driven by our productivity growth outlook. I think if you look at historically, there's two preconditions for getting strong productivity growth. It's one that you had a tight labor market previously, which indicated that labor was difficult to find and expensive. Historically, that always leads to firms finding ways to enhance productivity through capital deepening or finding other innovations. And when you look at wage growth over the past 2 years, it's accelerated substantially, suggesting that productivity growth should continue to accelerate. The other thing that is typically a precondition for strong productivity growth is having some innovation or productivity enhancing innovation that can disseminate throughout the production processes. And AI could certainly represent that at the moment, as Salita had kind of mentioned. So we see an environment over the next 2 or 3 years, or 3 to 5 years, if you think a little bit longer, for productivity growth that can be quite robust for the US economy, lifting potential growth above 2%. Maybe just finally on the election, and I'm sure we'll talk more about it, there'll be questions around it, but maybe just a few areas where we are somewhat more out of consensus than others. One, on the fiscal deficit, CBO's estimates right now are that we're likely to see about 5.5% of deficit to GDP on average over the next 5 years. We think it's likely that you see closer to 7% budget deficit to GDP, regardless of who wins the presidency. And in part, that's because if Harris were to win the presidency, she'd be likely coupled with a Republican Senate, which would renew a lot of Trump's tax cuts, and she wouldn't have the offset from tariff increases. And so you could very well see perhaps even larger budget deficits under Harris than you would under Trump. Finally, on kind of tariff policies and trade policies, we are of the view that Trump very firmly believes in the use of tariffs in order to achieve trade objectives. I know that many in the markets believe that these are simply used as leverage to try to get outcomes that they want. But I would recommend reading Bob Lighthizer book that he published over the past year. It really does suggest that both he and President Trump over many decades have held a view that tariffs are a very important tool for achieving objectives on trade, but also for the broader economy. So if former President Trump does win the election, we would expect that you do have a ratcheting up of tariff tensions, trade tensions. That will be a negative supply shock for the economy next year, and much larger than what we had during the first trade war, just given the scope of the tariffs that are being indicated at the moment, both with the universal baseline tariff and 50 to 60% tariffs on China. For the Fed, that negative supply shock lifts inflation and reduces growth. So if we were still in a high inflationary environment, we would expect that could be a more hawkish story for the Fed. But in many ways, I think the economy in 2025 will look like the economy in 2019, with growth closer to 2%, a labor market in better balance, and inflation closer to 2%. And so a trade war at that point could very well lead the Fed in a little bit more of a dovish direction. So maybe just to summarize from our end, I would agree, certainly on the soft landing prospects that the other panelists had mentioned. From a labor market perspective, it has clearly come into better balance. There are some downside risks if layoffs pick up. The Fed is on a cutting path now. We think eventually getting back down to 3.25 or 3.75%. But the debate over 25 versus 50 will remain live over the coming months, depending on how the labor market develops. Over the longer term, we're more constructive on U.S. growth, mostly driven by productivity, and the election outcome, is highly uncertain given the polling that we have at the moment. But on the fiscal front, we think both candidates would lead to similar deficits. A big difference would be on the trade front. Why don't I stop there, Venki?
Thank you so much, Matt, and thank you to all our panelists. You certainly gave us a lot to chew on. So let me start kind of at least summarizing some of the themes in the questions, and then I'll start with that. The first question is actually for Solida from Ed Altman. But perhaps I'm going to frame that in a way that I think all three of you can weigh in. And I think that kind of raises one concern or one red flag about the somewhat rosy outlook, which I think that all three of you share to some extent. And so Ed's question is about Chapter 11 bankruptcies, which are at the highest level, highest ever 8-month totals, year-to-date totals, even higher than the GFC years, and growing over the last couple of years. And so that's so I think Ed was asking about how that fits in with your rosy outlook, with the overall outlook. I want to turn that into a broader question about what are you watching in terms of indicators to see where the downside risks might be stronger than that thing. And I know Matt mentioned layoffs as one indicator, but are there other signals you're monitoring to see if a downside risk materializes over time? So why don't we start with Solida, followed by Matt, and then Aparna.
So, look, I think in terms of the downside risk to the economy, I guess, I'm going to, I think one of the biggest downside risks is, again, related to consumer, right? If the savings rate picks up meaningfully, as the excess savings deteriorates, and as a result, the pullback in consumer spending would be much more severe. And I think, when you look at the U.S. economy, there's really no other factor, from my perspective, in the economy that can offset that. We're still at a sub 3% savings rate. It actually, I guess, tended low recently, but this has been part of what has fueled consumer spending. Pre-pandemic, we were closer to 7%. But if we move anywhere close to that level, I think it's going to be quite tough to extend this expansion further. Like I mentioned, it's not our base case. We see a more of a gradual increase or flat movement in the savings rate, and the data is very noisy. And the data is actually, I think, it's just really an estimate. So it's very difficult to forecast the changes over time. And to know what is actually happening beneath the surface. But I would say that is an important risk. I would say in terms of credit, we're not seeing that much stress in credit markets. Credit spreads are actually, quite, quite constrained. A lot of the questions that we have been getting around, like as it relates to credit, is around the commercial real estate, is around is there a private credit bubble? Is that what's gonna? Is there a systematic issue with the regional banks? I mean, all of these things are, what we are watching. I mean, when it comes to commercial real estate, we don't see this as an 08 type of moment. There in 2024, we were already in the back half. There's quite a money that is like a dry powder that is waiting to invest in this in the distress, and I think it's already started being put to work. When we look at regional banks, I mean, the ongoing concerns around commercial real estate and the impact on the banking system has been a pretty popular concern or question, which sort of died down a little bit, but it certainly pops up. We don't believe that it is representative of a broader crisis there as well. I think the exposure for banking sector is pretty manageable and well ring-fenced. I think it is more of an earnings issue than capital issue over the next few years. Not so detrimental to disrupt the entire banking system. In terms of like other risks, I mean, private credit, again, certainly a huge growth in the last decade. Don't see it as a bubble. I think, I think, we have potentially more competition from the public markets as capital markets are open. But I don't think it will meaningfully impact demand. We're watching the underwriting standards and covenants so that they wouldn't be too lenient. However, so far the data does not support that this is happening, as defaults in this market are still relatively manageable. So these are the risks we're monitoring. But yet still we are in the soft landing view perspective scenario because any of these risks are not flashing red for us right now.
Matt, over to you.
Sure. I would maybe extend the kind of concerns around bankruptcies to what we've seen for households as well. So there has been some concern around the rising and delinquency rates that we've had from credit cards and auto loans. But I think it's important to maybe get a sense of what is driving some of that. So in speaking with banks in the US, they indicate that a lot of the rise in delinquency rates were driven by the COVID vintage lending data. And if you think about what happened during that period, you had households that were kind of flush with cash that led to an inflation of credit scores. So households that previously would not have had the lending that they kind of gotten were able to get the lending because credit scores picked up during that period of time. And then eventually, as savings came off, a normalizing of household balance sheets, we saw delinquency rates pick up for that vintage of lending. But outside of that, it does not appear like there's been kind of stresses for households in terms of delinquency rates that we've seen. And I think, when we see those quarterly delinquency rate data from the New York Fed, it's important to look at the quarter on quarter changes as well. They've essentially flatlined over the past quarter, suggesting that we've peaked and are likely to start to be coming down over the next several quarters. So I don't share, too much concern at the moment about rising delinquency rates for the consumer. I think for the most part, we are returning to an economy and a consumer and a household that looks a lot like it did in 2019. Again, where there's a lot of heterogeneity. There are typically stresses at the lower part of the income distribution, and that's kind of a reality of the U.S. economy. The other point that I would just mention, maybe just to build on the layoff story, is understanding the labor market right now is it's incredibly interesting in many ways. So one measure that we look at is a measure of labor market churn. So it takes hiring plus total separations including quits and layoffs. This measure of labor market churn is 90 to 95% correlated with the unemployment rate before the pandemic. And essentially what it tells you is when there's low churn, the unemployment rate's high. And the idea is because you have quits that collapse, hiring collapses, and that more than offsets the layoffs that take place. We have very low churn in the labor market today. Hiring is low, quits are low, layoffs are incredibly low. It'd be consistent with an unemployment rate that's above 5%, yet we're at 4.2% at the moment. And so understanding that I think is difficult. We've proposed some ideas. I don't think it's about labor market hoarding or labor hoarding, because if it was, what you'd want to see is low average work week, very low productivity growth, because essentially people are holding on to workers and not working them at all. We see the exact opposite. Productivity growth is strong. The average work week is pretty normal. And so, Venki, if you kind of go back to your labor matching models, you can imagine you get a big shock. It leads to this big reallocation of labor in ways that people can optimize across where they are from firms and households. You have greater work from home policies that can lead to that greater optimization as well. And if after that shock, you would expect to see low layoffs, lower hiring, lower quits, and big productivity growth. Essentially what we're seeing. It's an optimistic view. I'm not sure exactly it's the right one, but it fits the macro data at the moment.
Yeah, I don't have too much to add to what was said. I do think it was interesting, like during the pandemic, one of the factors we were tracking is consumer spending, right? Like here's an economy where there's massive job destruction and people are losing their jobs and so on. But I think with all the fiscal support that was provided and, the cash flows and so on, we still had a pretty resilient, savings rate, and we still had, consumers sort of spending was sustained over like at least the 2 to 3 years after the pandemic. So I think one thing that I think Sulita touched on a little was, how is the consumer feeling, and are they going to continue to spend at the same rate? And I think where I see risks are in those, the retail sales sides, like where is the consumer, going to continue to spend at the rate that they have? And if they don't, what does that mean for demand, and what does that mean for businesses? The second thing, again, that we were tracking closely during the pandemic was, the layoffs. But, there was a huge increase in temporary layoffs, so people who could be recalled, within 3 months. And that was really what was, driving a lot of the unemployment rate increases. So I think the minute you start switching away from, I think that's kind of, where we are right now. Like even the layoffs are, more on the temporary layoff side rather than the permanent layoffs. But I think the minute you sort of start tracking and saying, okay, these are permanent job losers, here's where the labor market is changing, that's a metric, that I think poses some risk going forward. But yeah, otherwise, I think just in terms of the labor market, just sort of tracking job destruction rates and, what's the pace at which people are quitting jobs, because quits are a sign of confidence in the economy. So if, and people are holding on to the jobs, that's already telling us that, they're not finding jobs at a high rate. And, that's a precursor to something that's coming. So, they'll obviously, you have to take about 10 metrics to really get a sense of the economy. But I think those are the places where I see, okay, maybe there's a slowing down that, we can start to track a little bit more deeply.
Great. Wonderful. So turning to the next topic, which I think all of you touched on in a little bit, is the election. And I'm going to kind of try and summarize some of these questions and present them to you as themes, but I'll leave it up to you how you want to expand on them. Right. So I think there are a couple of different aspects. One, which I think at least a couple of you touched on in some detail, is the role of tariffs, or is the outlook for tariffs and how that's going to become a policy, a key issue going forward. But I think a broader, I think tariffs are part of a broader move towards industrial policy, one where the government much more actively kind of puts its finger on the scale, right? So this is either in the form of tariff and tax policy, sometimes through direct subsidies like the CHIPS Act and other forms of that. And I think what I wanted to, what some of these questions have to, and there are other things like Build in America type of requirements, or there are restrictions on union labor, on public projects. There's a whole bunch of things where we are seeing it move towards a greater role for government in dictating the allocation of resources. And I wanted perhaps to get your thoughts on, this might be a slightly more medium-term phenomenon, how that changes your outlook or your thinking for U.S. growth and for perhaps U.S. Equity valuations and so on. So that's kind of one part of my question, and I'll give you one more, and then I'll hand it off to you. Some of you mentioned trade deficits and fiscal deficits under the two possible scenarios. One of the questions I think that keeps coming up, but then gets brushed aside after some discussion, is the risk posed by a burgeoning debt and deficit picture in the U.S. And I know we talk about it all the time, and then we say it's a concern, and then we go back to other stuff. So I wanted to kind of get your thoughts on how you see that playing out, how you see that risk manifesting. So I'm going to start with, just to mix it up a little bit, I'm going to start with Matt this time, and then Solita and Aparna. And I think, Aparna, when it comes to you, you're obviously, you spend a lot of time thinking about inequality and social safety net type of policies. And to the extent that you think the election is going to have significant implications for that, please feel free to use this question as a launching point for that. So let's start with Matt.
Sure. I'll maybe try to address both questions, but briefly. So on the deficit question, it's certainly one where last year we learned, at least episodically, the market cares a lot about deficits and debt. From the late July period, early August, when U.S. Treasury had their quarterly refunding announcement and guided towards a sequence of increases in coupon issuance, up until essentially November 1st, when they guided a little bit away from that. They cut the coupon issuance a little bit relative to expectations. The Fed shifted in a dovish direction. The primary focus of markets over that period was who was going to buy U.S. Treasury debt, and I could see that seeing our clients, including in Europe, as you saw U.S. 10-year yields hit 5%, 30-year yields hit 5%. But the reality was it didn't take much of a policy response, both from the Treasury and the Fed, to completely eliminate that concern from an investor perspective. And at the moment, we're sitting, 3.6%, 3.65% on the 10-year Treasury yield, and nobody has any problems about holding 10-year Treasury debt, even though the deficit and debt picture has not changed at all. And so, what that certainly taught me, this is not going away. You look at debt to GDP, it's not sustainable on any type of view or metric. Deficit to GDP will be revised higher on the CBO estimates, kind of irrespective of who we have. But the market needs kind of a catalyzing event to focus on it. And if it's during a period where the Fed is dovish, everybody's going to be willing to get long duration and therefore will not be concerned about taking on that duration risk. And so I think it has to happen in a period where the Fed is stable, we're not concerned about downside growth risks, but then we're also seeing rising coupon issuance. I think that could come back late next year as a story, but probably not before then. Second, kind of on the tariffs and trading, kind of industrial policy, I think it's pretty remarkable. I mean, it's one area in a highly polarized world where both sides agree that something kind of needs to be done. They might disagree on the tactics, but I referenced Bob Lighthizer book before. He actually was pretty complimentary to some of the industrial policies of the Biden administration. And so I think if you were to look for areas where there is agreement on both sides of the aisle, it's on trade policy with China, it's on industrial policy in the US. That industrial policy mostly focused on either climate change or on building up critical infrastructure around chips or other infrastructure projects. And I expect that will continue. I think it is mostly reflecting a population that is kind of clearly shifted their view on things. And it's notable that neither side in Washington can sound more dovish on China or kind of push back on some of the industrial policies that we have. In terms of the impact of what that has, Certainly the trade part of things is a negative supply shock over the near term. And as I kind of mentioned, and that will dent growth and lift inflation. But I think we've also learned, particularly in response to the pandemic, we need to have more solid supply chains. They need to be more robust. And so it may, lower our kind of modal forecast over time, but during periods of stress, it may actually help to truncate some of the downside risks there. So I think that's how I would kind of think of from a trade perspective.
Go ahead, Salita.
Okay, great. Maybe I'll just start with the deficit question. I mean, of course, the deficit is concerning, but I don't think we are at that imminent crisis levels yet. So maybe one of those people that you're mentioning, pushing it aside after a bunch of debate. But I think, one measure of this has been, the ongoing stability of the US dollar versus other major currencies. Still, particularly concerning is obviously that interest expense on the debt is starting to soar, and of course this will result in more supply needed to pay off debt. And now that the buyer of this debt is more price sensitive, given the Fed is not in that QE cycle, so it is, I think, one factor supporting maybe structurally higher rates than before. And we talk about this a lot. We get this question from our clients a lot. Typically when interest payments become one of the largest line items in the budget, that's when politicians say we have to do something about this. And, it constrains you on what you can spend money on. For example, right in the late, I believe it was 80s, early 90s, there were greater calls from financial markets in the form of higher rates to get that debt and deficit under control. At the time, interest as a percentage of GDP was around 3%. Now I believe we are in like a 2.5% rate. So we're getting closer to those levels. So I think it will be a market that's probably dictating when it's time to finally do something about it. And beyond that, the economic consequences largely really depends on how the government addresses the problem, which, to your point, gets into the politics. I think it's really hard to imagine, that the public finances can be put back on a sustainable path without a significant tightening of fiscal policy, including both spending cuts, tax increases, all of that. But it's very complicated given this current political climate. I think the biggest risk is the government has to roll out significant austerity measures during a recession or another period of economic weakness, right? So on one hand, you want to take care of it when you don't really have to. On the other hand, it's unlikely that anybody is going to do that unless they really will have to. And I'm just keeping my fingers crossed that the have to period does not coincide with a recession. So in terms of the industrial policy sort of impact on growth, I think, when we think about these protectionist policies from a sector standpoint, I try to remember that, there are two sides to this equation, right? You have the deglobalization, obviously, which is a risk with higher costs, higher inflation. But the opportunity on the other side is localization enabled through technology, which can bring down costs, higher productivity, greater resilience. And I think the way these two forces net out won't be really the same in every sector. The industries and the companies that I think will more easily adjust to a fragmented world. I'm kind of thinking all these policies are with a little bit of a more, I don't want to say America first in mind, but kind of. I think are the ones where localization is simpler and has, frankly, powerful economic benefits. I mean, I'm thinking back at history, how music streaming online, right, basically eliminated an entire global supply chain from the plastic production to make that disk. I don't even know if your students over there have even like dealt with a disk, but anyway, but it basically, eliminated to make this to the paper on the cover, right? You no longer need that. But it happened so quickly, and it had huge benefits. Fashion could be similar, where robots make clothing instead of them being handmade in mass overseas. But if you look at something like, I don't know, autos, localization is a lot harder to do, and the risk from the globalization could be an overhang for longer and more costly. So I think from sector to sector, it will probably, I think it will probably be different.
Aparna, go ahead.
Yeah, I'm going to talk a little bit about your larger question, Venki, around taxes and regulations and the elections, and given some thought to how the two people in the White House may differ. So obviously, I think one big talking point is the Trump tax cuts, and what happens with the new Trump presidency. I was one of the people who had actually written one of the first academic research papers that sort of talked about the incidence of the corporate income tax and how it might actually, cutting rates might actually benefit, low wage workers. Having said that, I think we're at the lowest we could possibly be. Like, I know we've heard, Trump say we could probably go below the 21%. I find that a little unlikely. On the other hand, if Kamala Harris comes into the White House and says, well, we are going to raise corporate income tax rates, I do think that there are people on the left and, sort of at least policy people, Democrats and so on, who would caution against raising rates really high. Because we do know from a ton of, we know anecdotally, we know from research, we know, how the business community reacts to really high corporate tax rates. What does that mean for, investment? What does that mean for productivity and wages and so on? So I feel like there isn't going to be, despite all the rhetoric, I don't see us going back to, let's say, 35% federal corporate tax rate. Like that, I just don't, even when President Obama was in the White House, he was campaigning for a 28%. He was talking about a 28% corporate tax rate. So yes, Trump went, much further than that, but I don't see us going back all the way. Obviously there is other talk about, unrealized capital gains taxation. Again, there doesn't, practically it sounds harder for someone to support that idea and say, yes, this is feasible, we're going to do it. On the regulation side, I think, despite, again, the rhetoric on both sides, there is agreement that you need a better safety net. You can expand things like the child tax credit, for instance, right? Like the Trump White House did it. Kamala Harris is talking about it. I think the worry is always that if the Democrats come in, is spending just going to go out of control? Because, they care about expanding the safety net in a way that isn't aligned with work incentives. And so, yes, spending is going to balloon out of control, and that, leads to deficits and, with more fiscal strain. But there is, I think it's important to remember that there are similarities. I agree that, both sides want to design policies very differently, and there are, one is a little bit more expansive than the other. But, what I'm hoping for is that there is a lot more alignment, in terms of, okay, this is what's feasible and practical to do. And this is really going to go out of control, and it's going to balloon the deficit, and we shouldn't be going down that path. So, I don't think we have a clear picture on, do taxes encourage economic growth, do regulations, restrict growth. You will find economists arguing for either. I think it's really about the specifics of what kind of tax rates are we talking about? Are they, can we implement them? Are they feasible? Do they really generate revenues? Or are they going to actually have a real impact on economic activity that in the long run harms the economy?
Excellent. So while we're kind of talking about slightly longer term thing, I thought I'll take that opportunity to pick your brain on another topic, which I think is of great interest to our students and to everybody who's tracking the economy, and that is about the effects of AI on the macro economy, right? So, Lita, I know you mentioned in your outlook about how, at least in the near term, investment in AI is going to be a significant boost to boost to growth. But I wanted to to get your thoughts on what your outlook is over a medium to longer term. Is this something that is going to be as transformational as perhaps some people think? Is it going to be more of disruptive to the labor market? And is that going to be the main story we are looking at a few years down the line? I recognize this is very speculative, but it'll be great to have your thoughts and what you're seeing and what you're hearing on this. And again, maybe we'll stick to the order where we go: Solita, Matt, and then Aparna.
Okay. I wish I had a crystal ball, but in the absence of that, I would say, I think people are naturally worried about the threat to jobs with AI, right? And I often think about, since maybe the first industrial revolution, right? Every technological change is often seen as reducing employment, but every time the argument has been, I don't know if wrong is the right word, but not maybe fully accurate, because some jobs will certainly be lost to artificial intelligence, but it will create new jobs as well. So I would say roughly 10% of the labor roles that exist at the end of any decade, I think did not exist at the start of the decade. So I think AI will make productive people more productive in the end, and cause shifts in labor, but not maybe necessarily in job loss in aggregate. And if you look back, again to history, it's clear how how technology causes these shifts, right? But ultimately brings, I think, greater productivity and job creation. We talk about this in our economics team quite a bit. Like in 1940, almost 40% of non-farm payrolls were in goods producing sectors versus about 14% today. But since then, we've also added about 125 million payrolls, and goods productions have actually increased. So yes, of course, I think it's disruptive. It changes, but I don't think it's like the end of employment. You just have to be, I think, kind of maybe curious or smart enough to be able to kind of see around the corner, and maybe that's for the future generations.
Yeah, so I guess from my side, maybe just a few points. One, I think it is really interesting tracking the monthly data. We are beginning to see, I think, show up some of the AI boom in the data that we look at. So, for example, you look at data centers in terms of non-residential construction, the growth rate in year-over-year terms has kind of skyrocketed. Two, you look at new orders for computers and related IT products. The 24-month annualized change on that looks a lot like it did in the mid-1990s. So kind of going back to that previous period where we had a big kind of IT investment boom that led to stronger productivity growth eventually. Three, look at chips imports into the US have completely skyrocketed in kind of recent months. So for a while, it was one of those things where you were looking for where could you actually see it in the activity or spending data. I think you're beginning to see that play out. From a growth and productivity perspective, my starting point on that front is I guess always pretty simple. I think you need a precondition for strong productivity growth is that you actually have had a tight labor market, which incentivizes firms to do that. I think interestingly, we've argued this at the macro perspective, but there's been Fed research that has identified this at the micro and kind of firm level. So they go through and they look at different firms, those firms that have identified labor constraints, and then they are more likely to invest in productivity enhancing projects. And so, I think you have this macro and micro story coming together with a very tight labor market that we've had over the past 2 to 3 years, just gives you this baseline, very constructive view on productivity growth. That I think is enhanced by AI, but I also would be very humble in telling you, we have not put out projections for, what the most likely outcome is there. I think there's both substantial uncertainty in terms of the magnitude of the impact, but also the timeline of the impact.
I agree with that. I think there's a tremendous amount of uncertainty. I know we've seen a ton of research say, this boom and this technological change could create a ton of job destruction. At the same time, it really depends on how I think employers respond to the use of AI, right? It's something that obviously every large employer and every tech company is thinking through. How do we create complementarities between the workforce and these new technologies? I think it's something, it's highly innovative, it's highly radical, but it's also along the line of, yes, if you go back decades, they're changing tech requirements. If you track what job postings, used to ask for 10 years ago versus what job postings, ask employees to have today, there's already a huge technological change, right? Like you're expected to know certain software packages, even as an SDE, even as, someone at the same level, 10 years ago, now the expectations are completely different. And so there is a thinking that even for those people, having access to AI that now helps you learn code, helps you write code, helps you, be more productive is actually really useful. And then how do we upskill, workers who are lower wage and who are, going to have to deal with the ramifications of these technologies now applied in their workplaces? How do we get them there? How do we make it happen so that they're not, losing out from this AI revolution, but in fact, their true skill sets and, upskilling actually happens as a complementary process. So yes, there is uncertainty, but I do think that there's a lot of potential to do good. I think it's all about how you harness the revolution in some ways. Even as economists, I'm like, I'm amazed at. I used to run models and, these old programs, and now I have these applied scientists who are like, wow, I can run this for you in minutes, right? That is productivity boosting. But I agree, at different levels of the wage distribution, that technology can work in different ways and can be used to actually enhance people's potential. So I'm optimistic, for the future.
Great, wonderful. So we're nearing the end of our time. So I want to close with something which I think may be a little bit different from what you've been talking about all along. There are a lot of students in the audience today, and all three of you are wonderful role models for our students. You've built successful careers over many years, and so what I wanted to perhaps pick your brain on, for maybe that's a short couple of sound bites on what they should keep in mind as they embark on what will hopefully be wonderful careers. So just, why don't I start with Aparna this time, Solita, and then Matt. Yeah, go ahead.
That's a good question, Venki. I don't know what, I think I've always been driven by interest and also just awareness. I remember I got into economics when I was growing up in India, and it was the early 1990s, and India was facing a big balance of payments crisis. And suddenly all you heard about in the newspapers was economics, right? Like, here's how unemployment will change. Here's how the GDP is going to change. And I was like, wow, I want to study macroeconomics. And so, you always, I think it would be unfair to say, oh, here's the right job for you because this pays best, right? I worked at a think tank for 15 years. Those are not the highest paying jobs, and I loved the work. You get to do so many interesting things. I explored research areas that I, may not have explored otherwise. I got to testify in Congress. I got to meet, amazing people in government and in policy circles. So one is, I think, just follow your interests. But I also would, I would say, sometimes we get driven by politics, like, oh, this is the right thing to do, or politically, here's where the economy is headed, and that's why, I want to focus on these careers or these kind of jobs. I think what I learned, especially as part of my think tank job, was to stay neutral, to listen to both sides, but really work with data and evidence, and to put forward facts, and always sort of use your judgment, and don't be swayed by anecdotes and opinions, and even news stories. So I think read widely, read from people across the aisle, have awareness of what jobs exist in your field and what are you truly, truly interested in, and follow your heart.
Sulita?
Sure. I really like Aparna's advice. Actually, a lot of the things that I echo. Maybe a couple of things. One is, I would say, don't overthink your, first career choice or first jobs out of school, because most likely the job you're going to have, or maybe even the company you're going to go to, is not where you're going to end up at the end of your career. So I think when we just come out of school, it feels like a life and death. It's so important. It's going to determine the rest of your career. But the careers are not linear. They have ups and downs. And I would say, obviously, do the best you can to get a job after school that gives you the most exposure, gives you a lot of learning opportunities. But I think that's pretty much what it is learning the content, learning, frankly, learning the politics, learning how things do get done, and then absorb it as a sponge and be proactive and pick up whatever you can. Don't overthink. Don't be upset if it's not the first choice that you wanted, if it's not that investment banking job or whatever it is. But beyond that, I think a couple of things that certainly guided me in my career when I was more junior, as I got more responsibility, is having courage. I think it's so important to be able to raise your hand, voice your opinion, take a risk. Having that courage, I think, is really, really important. Oftentimes we think, if I do my job and do my job well, people are going to recognize me and they're going to open up opportunities. Maybe if you're lucky, but that's kind of not how it works. You're in charge of your own career. Building a safety net and network is critical. Both people who are going to open doors, but also people who are going to sort of shake you up and help you translate situations when maybe you can't see through. And now finally, I would say, write down your goals. I think writing them out and putting them out in the world is very important. When I was at NYU Stern Business School, I took one class, I think it must have been my second year of MBA, and there was a course, and it actually, the paper, it forced us to basically write out a whole career. I'm like, I don't even know how it would go, but it doesn't matter. You don't need to follow it, but think about, write out goals. And I still think back to almost 20 years ago, what I've written, and funny enough, some of those things actually have come true, and I just thought that I was just way above my skills. I was just maybe exaggerating. So those are my maybe 2 cents.
Matt?
Sure. Maybe 2 things. One, be willing to take some risks. Calculated risks maybe, but risks nonetheless. 2 examples from my perspective. Coming out of undergrad, I had an accounting and economics degrees, and I had kind of a full-time job offer to go and work for an accounting firm. Would have been a fantastic job, would have been very safe from my perspective. But I loved econ, and so I wanted to go down the path of going to get a PhD, which is not certain, it's not sure, it is a big risk. You don't know how it's going to work out. But that path led me to kind of go to the Federal Reserve and meet a lot of people in terms of monetary policy, academics, and things that I wouldn't have been able to otherwise. Second risk, kind of midway through my career at Deutsche Bank, they asked me to move to London at a time from a family perspective that was very inconvenient. We had just had our first son, 10 months old, was not a good time to move. But we did take that risk, and from a career perspective, it turned out to be fantastic. Got to meet people within the organization. Showed my willingness and ability to kind of take some risks and do some sacrifices. But it also turned out to be a fantastic opportunity for my family. We loved living in London for the year, even though we were quite hesitant to do that before we moved. Second one, it's probably going to sound a little bit weird, but kind of be willing to do the thankless jobs that are there. So one example is just at the Fed. Two things that I did there. One, I was kind of our IT guy as a research assistant for setting up the lectures when academics would come in. Nobody liked to do it because it was all downside if the IT didn't work out, and there's no upside to it. But at the same time, I got to meet Tom Sargent and talk to him when he came in. I met a number of professors that were out there that would, either when I was applying, I knew people's names, they knew my names, kind of tremendous conversations. The other thing was at the Philly Fed, I took on part of the responsibility of sitting down and constructing the staff forecast along with the economists. It was kind of a days long thing where you're sitting there going cell by cell, and nobody really enjoyed it. But that thought process and the process of going into, thinking about forecasting, whether it's from a monetary policy perspective or from economist perspective, it's something that has kind of been invaluable. So those two things, kind of take some risks, be willing to do some thankless jobs.
Wonderful. Well, thank you so much. Well, this isn't a thankless job. You have our greatest thanks. So on behalf of everybody here at NYU, I want to thank all three of you for taking time out of your busy days and sharing your wisdom with us. You've given us a lot to think about and has been tremendously useful. Thank you so much. And thanks to all the attendees. I say that attending one of our events is like making a political donations. We have your emails for life. So you're going to keep getting events and updates from us. So please, I hope to see all of you at future events. Thanks again to the three of you, and thanks to everyone who attended. Thank you.